When I embarked on this study, little did I know how complex it was. There was even a new language to learn, with terms such as GFC, which is a global, systemically important financial institution. We have GFCs and DFCs, among other things. Finance as an industry may be shrinking, but the regulation of it is a booming industry. The regulatory responses to the global financial crisis raise many questions and issues, and I don't pretend to have the answers. I have circulated in advance to all of you a background paper which attempts to set the scene by clarifying the issues. And as I make this presentation, I will express some opinions along the way. But as I say, I don't have the answers. When I hand over to Professor Ian Harper soon, I hope that he will have the answers, of course. So I think that a good place to start is to look at how increased financial regulation fits into the overall schema of policy responses to the GFC. First, we had the emergency bailouts and rescues in late 2008, then the fiscal stimulus measures, which in some countries have given way to fiscal consolidation. And that at the same time, monetary policy came to the rescue, initially in its orthodox form and subsequently in less orthodox forms, such as quantitative easing. And then since 2009, as I've described it, we've had the boom in financial regulation, which is seen officially as a permanent structural change in response to a structural fault that was revealed by the GFC, while the other three types of policy responses were meant to be temporary or transitional, though they've turned out to be rather less temporary and less transitional than expected at the time. Increased regulation of finance will stay with us long after the other policy responses have gone, and will stand as one of the enduring legacies of the GFC, the benefits and costs of which will be with us for a long time. Historically, there is a pendulum in financial regulation, and it is useful to put the latest swing of the pendulum into a long-term historical context. The overall set of policy responses to the GFC, as described in the previous slide, take us back to the 1930s in the search for anything comparable, at least in peacetime. That was the last time the world saw a tightening of financial regulation on anything like the scale we are seeing now, as post-Depression concerns about financial stability trumped efficiency considerations. Finance remained relatively repressed for many years after the 1930s and only began to be liberalised in the 80s and 90s. Now the pendulum has swung again as the GFC and the Great Recession have brought concerns about financial stability to the fore. Those concerns are understandable, but they are not a reason for disregarding the immense benefits of an economically efficient financial system. We have to keep the GFC in perspective and get the balance between stability and efficiency right. But it will be a long time before the pendulum swings back to less regulation, though I expect that will eventually happen. So what is being done at the international level? First and foremost is Basel III, which mandates, among other things, more and better quality bank capital, less leverage, and more and better quality liquidity. I won't go through the details, which I'm sure are pretty well known to everyone. The increases in minimum capital adequacy requirements are significant, and Basel III introduces for the first time a capital conservation buffer above the minimum, a counter-cyclical buffer, and a surcharge for those SIFIs that I mentioned. It also introduces the concept of living wills for financial institutions, which are supposed to spell out in advance how they would attempt to cope with a life-threatening experience and how they would be disposed of if they failed to cope. But Basel III is not the sum total of the international regulatory response. The Financial Stability Board has all sorts of other topics on its lengthy work program, such as accounting standards and remuneration rules. And some countries have already said that they will go above the Basel III capital adequacy standards. And then on top of that, you have such things as the Dodd-Frank legislation in the United States, which among other things introduces a version of the so-called Volcker rule restricting commercial banks' proprietary trading activities. The UK is going to ring-fence retail banking, and the European, not to be left behind of course, is developing a vast network of new regulation, as well as being very enthusiastic about new taxes on banks and financial transactions. Before looking at the issues raised by these kinds of measures, let's take a step back and consider the diagnosis of the GFC on which it is based. The most popular narrative surrounding the GFC identifies banks, especially the big banks in the US and Europe, as the prime culprits. Officialdom has adopted this narrative and in many cases promoted it. Hence the regulatory onslaught aimed at reducing the risk of such financial crises in the future and reducing their magnitude and consequences when they do occur. But we should not forget that there are other diagnoses of the GFC which give star billing to factors such as loose monetary policy, lax supervision of financial institutions under the previous regulatory regime, global economic imbalances, and policies in the US that went too far in encouraging home purchase. In my view, these factors were to blame in the sense that they set the scene for the crisis, but the behaviour of financial institutions made the crisis much worse than it would otherwise have been. There is therefore a case for regulatory reform, but I think that what is being done is in some ways misdirected or excessive. Looking at the international, and these slides essentially repeat the list of issues that I put in that discussion paper that was circulated before. Looking at the international responses, it is difficult to argue with higher capital adequacy standards and increased liquidity requirements in general, and the capital conservation buffer seems conceptually sound. But I think there is a big question mark over the wisdom of macro-prudential regulation, counter-cyclical capital surcharges, and capital surcharges for systemically important institutions. The buffer and surcharges could accumulate to some very high capital requirements, as high as 20%. And one can't help wondering whether there is an element of overkill in this. And looking at the so-called living wills, the development of resolution plans is at an early stage, and it remains to be seen if this concept is workable at all. Looking beyond Basel III, the US Dodd-Frank legislation is a regulatory monster of 848 pages. And that's not the end of it, because it's going to give birth eventually to some 400 separate rules and regulations. The Economist of not the latest issue, but the one before, had a very good critique of the Dodd-Frank legislation. I recommend you look at it if you haven't already. As far as the bank levy and financial transactions taxes are concerned, I find it difficult to see what they will achieve other than generate some more revenue for European governments that are always revenue hungry and eager to tax anything that moves. But at least so far the idea is not catching on outside of Europe. In Australia, it is good to see where the regulatory response is more measured. It is good to see that the authorities are sticking closely to the Basel III script, being a little more conservative in some respects, but not going beyond it. One wonders why even the Basel III prescriptions needed to be adopted in Australia, other than to be a participant in an exercise in international cooperation. I say that because of how well our banking system got through the GFC, of course, with the help of the Commonwealth guarantee for wholesale borrowings. But had we not gone along with Basel III, our banks would have been perceived internationally as being relatively less secure. Some countries have gone beyond Basel III, and I wonder whether there will eventually be pressure to do the same here. Also, we have not yet seen in Australia what the move to capital surcharges for domestic SIFIs will imply. None of the Australian banks has been declared to be a global systemically important institution. There's a list of 30 of those, and none of them Australian, but they are still working on the capital surcharges for domestic systemically important institutions, and at least our 4 major banks will be in that category. The concept of too big to fail looms large in the discussion of regulation and has motivated much of the regulatory response. While the authorities had no choice, in my view, but to bail out major institutions and facilitate mergers in the depths of the 2008 crisis, those actions have increased moral hazard and created even more dominant institutions. It remains to be seen whether the current array of regulatory responses will adequately address the too big to fail problem. And in any case, I think it is not clear that size per se is the issue, or whether it is something else, such as complexity and behaviour. And let's not forget that there have been financial crises in the past involving a large number of small institutions, not necessarily a small number of large ones. Regulation must have economic consequences, and it is here that I come back to the title of this round table, Regulation or Strangulation, which alludes to my view that the current regulatory push puts at risk the economic efficiency benefits of a relatively free and innovative financial sector for the sake of financial stability, which may or may not be achieved anyway. Official agencies such as the IMF assert that the increased capital adequacy standards will have only a small effect on economic growth, and that much of this can be offset by monetary policy anyway. And that may be the case when capital standards are viewed narrowly, but I think their calculations may be missing the dynamic costs of reduced financial innovation. Finally, I note that policymakers and regulators are working within the same broad framework of banking as has existed for the best part of a century. But there is a view that any system of regulation within this framework will ultimately fail to achieve its goals because the framework itself is conducive to instability. I refer to the work of Kevin Dowd and others at Cato, who have argued that it is time to go back to the extended or unlimited liability structures that characterised US banking a century ago, which they say worked much better because the principal decision makers bore the consequences of their own mistakes. This is what I've called in my background paper a radical option, and I suspect it is just too radical to gain acceptance, yet anyway. I will give the last word to the Governor of our own Reserve Bank, quote, "It will take a great deal of determination on the part of regulators to enforce arrangements adequately in future booms, and there is little doubt that such booms will occur because ultimately the cycle of greed and fear itself cannot be regulated away. To assume that unrealistic optimism will not again at some point overwhelm the more sober instincts of investors, bankers, commentators and others would be a triumph of hope over experience." And that goes back to the comment I made earlier, that this search for safety and stability may fail anyway, but still impose its economic costs. Now, it is my pleasure to introduce Professor Ian Harper, who is very well known to you, I'm sure. Among other things, Ian was a member of the Wallace Inquiry and put him at the forefront of financial market reform in Australia in that capacity. He had a 16-year career with the Melbourne Business School, which led to him being elected as Emeritus Professor on his departure in 2008 for Access Economics, which of course has more recently become Deloitte Access Economics, where Ian is now a partner. And of course from December 2005 to July 2009, Ian served as inaugural chairman of the Australian Fair Pay Commission, which of course has now given way to another entirely different set of institutional arrangements, but that's a topic for another day. So I'm pleased to vacate the podium for Professor Ian Harper.
Thanks, Robert. Well, ladies and gentlemen, I'm indebted to Robert for introducing into the discussion an historical note, because I think it's important when thinking about financial markets and financial market regulation in particular, developments that we're presently living through, to have an historical perspective. After all, these issues that we're dealing with here aren't new. When I joined the Reserve Bank as a young cadet back in the early 1980s, my colleagues who are here today are also ex-Reserve Bankers. They might think the world didn't exist back in the 1980s, but it did. Austin Holmes, a great economist and well known to a number of people in this audience, made a point of coming down to my office and handing me a copy of Charles Kindleberger's book, Manias, Panics and Crashes. And he said, "Glad that you're here. Have you read this?" And I said, "Oh, as a matter of fact, Mr. Holmes," I said, "I haven't." He says, "Then read it and make sure you understand what's in it, and then pray that you don't live it while you're here." And off he stormed. It was a wonderful thing for him to give me because, of course, it made the point, as subsequent works, including Niall Ferguson's wonderful Ascent of Money, made the same point, that there are very long waves in the history of financial markets, waves as Robert's just quoted Glenn Stevens as describing, waves of greed and fear. In more recent times, an alternation between regulatory pressure in financial markets and deregulatory pressure. I'd like to describe it, and Robert's used the terms as well, as a sort of oscillation between concerns about stability and concerns about efficiency, recognizing the strength of the market as an allocative device, as a source of dynamic efficiency, over against its inherent instability. And the pluses and minuses, the costs and benefits, seem to be writ large in the case of financial markets. The same tension exists, of course, in any marketplace. But things happen quickly in financial markets. I stepped into the story of Australia's financial development in the late 1970s thanks to the good offices of Tom Valentine, who's also with us today. Tom was the Senior Economic Advisor to the Campbell Inquiry, and I was a student of Tom's, and I had the privilege of being involved in some work for the inquiry. You'll recall that that inquiry instituted what was widely seen as a wave of deregulation, particularly when it was picked up by the former Treasurer Paul Keating, and that was something that we'd not experienced for quite some time, basically since the Great Depression, prior to which financial markets were basically unregulated, or certainly regulated by a very minimal set of provisions. Notwithstanding the fact that the Campbell report is often thought of as deregulatory in nature, and it clearly was, there was a strong undergirding within that report itself of the need for what we would now call prudential regulation and prudential supervision. Even Campbell didn't think that the financial system should be run completely free of any sort of intervention. Indeed, it was recognised that what we're about is trying to draw a line, trying to balance the forces of efficiency against the demands of stability. I also speak with some trepidation as I recount this anecdote with John Stone, a member of our audience today, who was, of course, Secretary to the Treasury at the time of the Campbell inquiry. The Treasury's submission to Campbell, if I'm right in saying so, John, mentioned the words fog of war. They quoted von Clausewitz. And here I'm paraphrasing, I suspect, but you can check the historical reference for yourself. John will correct me if I'm wrong. I believe the intent of the submission at the time was something like this. In the fog of macroeconomic war, microeconomic efficiency losses are collateral damage. Now, those weren't the exact words, but the intent, you can see, is the same. Here is one of the two public agencies responsible for advising governments and overseeing stability in the Australian economy, reminding the committee that the costs of instability weigh heavily, not necessarily denying that there aren't also costs of inefficiency, both static and dynamic, but reminding everybody that the costs of instability are large. Now, nowadays, post the GFC, we have exactly the same refrain being put forward, certainly in a prominent case, by Andy Haldane at the Bank of England. And Haldane's actually added to the sentiment with some calculations, which you can consult for yourself. And Haldane points out that the present value of the instability which the GFC gave rise to is extremely large. And in particular, in Haldane's view, is much larger than the costs that even the more alarmist predictors have attached to the interventions coming through Basel III. Now, I'm not here to either endorse those calculations or criticise them. I'm making the point that the same argument has arisen once again, and that the theme, if you like, of today's discussion, I think, or the frame within which I think about these issues, is exactly the same frame. This is an area, primarily, I guess, because of the inherent asymmetry of information which afflicts financial markets at least as much, if not more, than markets generally. This is an area in which basic market inefficiency is going to arise and going to be a problem. And the more interconnected financial markets are, particularly globally, the larger the potential costs of instability are. Of course, the costs of inefficiency are also large. Typically in an area like this, we tend to oscillate as one comes to the fore relative to the other. Obviously, with recent experience in mind of the global financial crisis, it's completely natural that we would have at the front of our consciousness the costs of instability. Over time, we'll once again realise the costs of inefficiency, particularly dynamic inefficiency, if the regulation does, as Robert's inclined to believe it might, strangle the financial system, then the costs of that inefficiency will come to the front of mind and we'll have more of this regulatory oscillation. I'm indebted to Robert in a second sense. I think he's given us a very helpful framework for thinking about the topic for today's discussion. And so what I wanted to do in the balance of my time is to just pick off the same 6 issues that Robert's brought to our attention and to make some comments of my own under each of those headings before we open up for general discussion around the group. So first up, was regulation to blame? for the GFC? Was regulation to blame? I think the answer is yes and no. Yes, there were clearly incentives to take risk off bank balance sheets. Securitisation, the movement of risk out of the intermediated system into the markets, is something which was aided and abetted by Basel I and then Basel II, regulations essentially putting costs in the way of intermediated finance taking place through the balance sheets of banks and similar institutions, promoted those risks being taken off into the marketplace. Now, as Robert mentioned, I had the privilege of serving on the Wallace Committee. We spoke a lot about intermediated finance versus disintermediated or market finance, and sought to not just draw a line between the two in our own case, but to create our regulatory framework which reflected that division. If we got one thing wrong, and I think we did get this wrong, we underestimated the extent to which finance could be moved out of one sector into the other, and also underestimated, if I may say so, I speak on my own behalf, not that of the committee, since they're not here to defend themselves, but certainly as I thought about these issues, I felt that I could draw a much cleaner division between intermediated finance and non-intermediated finance than history has shown to be the case. The other thing I think we got wrong, or I got wrong, was in recognising or thinking that the intermediated banking system would be the only source of systemic risk. And so we gave responsibility for managing or overseeing systemic risk to the central bank, believing that systemic risk was essentially about bank runs. The surprise to me, and I think to many observers from the GFC, was that these types of systemic crises can arise and be communicated through financial markets. And what that gave rise to, I think, was the recognition that many of these risks that had been taken out of the banking system and put into securitisation markets and securitisation vehicles ended up being disconnected from any process of oversight. There wasn't anybody watching over the management of these risks, it would appear. Oh, the market, I hear you cry. Yes, well, the difficulty was that the market disappeared just when you needed it. The market that I thought would always be there to pay some price, albeit a low price, for securities, ended up paying no price at all because the market itself had closed. Now, you may well call me naive. Maybe I am. I can hear the voice of Austin Holmes saying, yes, you were naive. Right? Well, then, guilty as charged. I thought that market efficiency would handle this, and the structure of regulation that we placed in our own country was designed on that presumption. That turned out not to be correct. One way to think about the GFC, apropos the last point I'll make about free banking, one way to think about it is this. Business moved from the regulated banking system to the unregulated banking system. Effectively, much of what happened in securitisation markets was unregulated banking. And if you're concerned about what unregulated banking might produce, then you might want to look at the GFC experience as Exhibit 1. So yes, the regulations did contribute, but then again, no, they weren't the only source. Obviously, there's a strong interaction with developments, the enormous global structural change which is occurring as a result of the emergence of China and India. So the savings glut which that produced, loose monetary policy in the United States to try and keep living standards up in the face of that enormous structural pressure on US manufacturing, all of that interacted with the financial system to produce the GFC. In our own case in Australia, this was a wholly imported crisis. We got into strife because of the difficulties which communicated to us via the financial markets. The same is true now of the second round in Europe. The real linkages through Europe back through China, yes, they're there, but the main linkages through which the European crisis will affect us, is affecting us, is again the financial markets. So it was a wholly imported crisis. I don't believe that regulation here in Australia had any role to play in producing the crisis for us. Well, turn it around. Did regulation spare us here in Australia? I think we can fairly claim, and I do so, I hope modestly, as one of the authors of the Wallace report, I think we can fairly claim that our regulatory framework was helpful rather than unhelpful in our response to the financial crisis when it broke on our shores. But I would be the last person to say that it was solely responsible for us doing reasonably well by comparison. Various other factors played into our hands. Firstly, again, history. Our regulatory framework was well oiled as a result of the shock and trauma associated with the failure of HIH. In particular, APRA, which my colleagues on Wallace and I had created as a light touch regulator, was suddenly, of course, instructed by the government post-HIH, the largest financial, indeed the largest corporate failure in Australia's history at that time. APRA was reconstituted, the board was tossed out, replaced by 3 commissioners, and given explicit instructions by the Treasurer, per the government, not to be a light touch regulator. And I think that paid dividends, as it turns out. The intensity with which APRA has gone about its task meant that by the time the GFC broke, we were in a very strong position to withstand the worst of that. I make the point also that our tradition here, not just post-APRA, I think the Reserve Bank had also developed the same culture, but certainly post-HIH with APRA, was to engage in supervision, not just regulation. We have a prudential supervision regime, and APRA, for better or worse, is an activist supervisor, not just a regulator. And I think that supervision is a two-sided coin. Yes, it may bring to your mind notions of unwelcome meddling, but it can also bring an early warning system. It means that the regulator is far better informed about what's actually going on and can make judgments and isn't simply passing laws and standing back. So yes, I think our regulatory processes worked well here, primarily because of the way they were implemented and as a result of a bit of history which was helpful. But they weren't solely responsible for us being spared. Again, the China story, which is good news for us, meant that there were substantial opportunities for growth here in Australia. We didn't have the need. Our financial institutions did not have the need to leverage themselves in order to achieve the higher rates of return which were necessary in countries like the United States, given their very different position in the light of what's happening in China. So our financial institutions essentially were bringing money into the country, not sending money out. And there was plenty of work for it to do here. Also important that in Australia we didn't have a housing crisis, again related to the circumstances, of course, of China and our immigration and population dynamics. If house prices had collapsed in Australia as much as they did in the United States, then arguably we would have been in as deep a mess as they are, or were, at that time, things looking a little bit more encouraging nowadays. Thirdly, will re-regulation through Basel III help? Well, let's quickly run down the list and ask what these things will do. Raising capital adequacy, as they propose to do, will reduce the capacity for financial institutions that are regulated in this way to increase their leverage. I mean, that's obvious. Many of our institutions already meet the base standard, but when you put in the different buffers and other adjustments, there's likely to be some increased demand for capital. And in any case, the institutions themselves will make managerial decisions on top of that. No well-run bank likes to be seen to be right down against the regulated minimum and is likely to add additional capital. We'll have to wait and see. That will reduce leverage, which reduces the capacity of the system to expand credit. On the liquidity side, the so-called liquidity coverage ratio and the net stable finance ratio, those two things together will help to manage a liquidity risk and help to stabilise funds flows. This is an area where Australia is exposed. It is the one thing the IMF always ticks us off about. If it isn't the housing market, it's the exposure of the banking system to wholesale markets. That's how international crises get communicated to us. Well, rules like the liquidity coverage ratio and the NSFR will help to insulate us from that. That's true. Of course, at the expense of the liquidity and maturity transformation function which the banks perform. There it is. You want stability? You need to switch off the very thing that the banks do to create economic value. Creating liquidity and maturity transformation ipso facto exposes you to greater risk. You want to dial that back? Go ahead. Dial it back in the interests of stability, but it will have an efficiency cost. Macroprudential regulation, well, I'm not a great convert to this idea, I'd have to say. For a start, I think it conflicts with monetary policy. In our case, we'd have two institutions, one trying to stabilise the macroeconomy through capital controls and the other through traditional interest rate movements. If we're really insistent on macroprudential regulation, we're going to have very close cooperation between those two institutions, not to imply we don't have it currently, but it might need to be institutionalised. And in the light of experience, maybe they should be in the one institution, and maybe it was a mistake to have divided them. That's just one dimension of the issue, of course. The difficulty for macroprudential regulation is when to apply it and with what intensity. We have no experience in that regard at all. I will make the point, though, in passing, that APRA already has the power to impose discretionary capital controls on institutions according to its own objectives of protecting their depositors. So for all I know, it already imposes a form of macroprudential regulation by changing the capital controls that it demands of particular institutions at different points in the cycle. I make the point that it has the power to do that now. The so-called SIFIs, as Robert has raised, yes, there is an issue with too big to fail, not systemically important institutions globally in our case, but certainly domestically. There is a concern that taxpayers are unduly exposed, even though taxpayers didn't lose any money this time. There is a recognition, I think, that the government would come to the aid of the party. On Wallace, we tried to deal with this by giving APRA no balance sheet and giving APRA no capacity to intervene and pay off the depositors, let alone the shareholders of banks. They would have to go to the Reserve Bank or to the government. The government, having guaranteed deposits and now replaced that with the financial claims scheme, has of course changed all of that. Again, maybe we were naive in thinking that degree of separation would deal with too big to fail. It looms now as a problem. How would you seek to protect taxpayers? Imposing some additional capital in order to recognise the impact of systemically important institutions domestically may be justified. Differential capital controls based upon significance of institutions systemically. It's clear that systemic risk is the big lesson to come out of the GFC. And it's also clear that in our case, our regulatory framework did not prepare us for that. And that I can claim some responsibility for. I thought systemic risk was about bank runs. I didn't think that it was something that would emerge so clearly in financial markets. Global standards, the idea of striking a blow against regulatory arbitrage, I think is a positive thing, other things equal. And I'm completely with Robert. My view of ring fencing and imposing transactions taxes is overkill writ large. We've had no difficulty in this country managing banks and investment banks. In particular, most of our banks are involved in investment banking, and that's never proven to be a big deal. Yes, the bank failures we've had have arisen because of shenanigans in investment banks. That's true. In both cases, of course, they were state banks, not regulated by the federal authorities. I think we've got that one under control. Mind you, I think it is a happy coincidence that throughout this period, all of our major banks were run by old-style bankers and not run by investment bankers. There is a very different culture between the two. To that extent, Mr. Volcker is completely right. And had one of our major banks been run by an investment banker, as opposed to a balance sheet banker, maybe things might have been different. Well, are the benefits worth the costs? I've made the point that this is all about trading off stability against efficiency. There are numbers that float around. APRA thinks that all of this will amount to no more than a 10 basis point increase in the margins of the banks. Maybe, maybe not. What we do know is this, that it will increase the margins that the banks charge because it must increase the cost of intermediated finance. That is the point. That's the point. And to the extent to which it increases the cost of intermediated finance, it will induce finance to find other ways into the economy. The most obvious way in which that will occur is through foreign direct investment. So while we close off or occlude that channel into the Australian economy, the capital importing Australian economy, the coming through the banking system, money will find its own way in. The current account deficit has to be financed one way or the other, and it will come in through foreign direct investment. So one question I've asked previously in public, and I think again it's important, are we certain that we have the machinery in place to deal with the increased foreign direct investment that these changes will imply for funding of business and investment in this country? That's just a question. I think the biggest loser from this process, to the extent that the margin increase is significant, will be small and medium enterprises. A lot of big enterprises will go off to the bond markets, and I think these developments here in Australia and offshore will give a fillip, certainly to the development of the bond market in Australia, and larger organisations will go that way. That'll also be driven by the increased demand for fixed interest investments that consumers are presently displaying. But I think that lending to small business will become an issue. In the bad old days of people having to go back to the bank manager cap in hand and possibly receiving only a fraction of what they've asked for, and in the meantime needing to secure their loans with all sorts of things, all of that, I suspect, will return. Is that worth paying in order to secure the stability of the financial system? In the end, that's a judgment that only all the people can make, I think, through the political mechanism. My point to you today is that it's sharpening up that trade-off, and we should think again about the costs in terms of both static and dynamic efficiency which this will impose. None of which is to say that instability isn't extremely costly. Fifthly, can and should we go it alone? I don't think we have any choice. We are a capital importing country. Yes, it's true that many of these changes we did not need. Most of them, certainly to do with capital, we already abide by. The rest of them maybe are a help at the margin. But would we have done this had we not been dependent upon foreign capital inflow? I don't know. I suspect there wouldn't have been such an impetus. But we are dependent on capital inflow, and as a capital importing country, quite frankly, we cannot afford to have the label emblazoned across our breast which says non-compliant. So I don't believe we have any choice, and I think that our officials have done a sterling job in trying to hose down the more enthusiastic proponents of change by at the very least carving out exceptions here and there for countries like ourselves and Canada. But is it possible for us just to turn our back on all of this? I think the answer to that is firmly no.